So we're seeing a flight to safety to treasuries. Meanwhile, I believe you're getting questions from clients about, I know it's impossible to fully time the market, but I think they want to know, is the pain that we're seeing today, all that red, is this the worst it will be? Or will the market continue to go down? And is there a better buying opportunity for equities in the future?
Look, when we are considering investor behavior in recent years, buy the dip mentality has been so strongly ingrained in investor psyche. And we are really curious to see whether the same attitude will kick in short order again. We think that we might have to wait a little bit for that, however. The simple reason being is we're not done with negative headlines. After the announcements yesterday, we expect to see all the retaliation announcements from U.S. Trade partners. That is likely to add to volatility. Then you will see a response from the U.S. to those retaliation announcements, which further could exacerbate fears within the market. So we think for the time being, it's probably too early to buy the dip. There could be more volatility ahead. Having said that, when we're looking at the range of risk indicators, we're close to hitting peak bearishness in a number of segments of the market. So once policy clarity is gained, once we have better information about what the end state of this trade escalation is likely to look like, we do believe there will be some investors who will be willing to step into the void, but we might have to wait a little bit longer for that. And those investors that are likely to step in are the ones that do not believe in recession as a base case scenario for the US. We are definitely in that camp. This is not our base case assumption, but clearly there's also a lot of investors who are very worried about recessionary risk ahead.
You fed into my next question. I was about to lay out a math problem where bearish markets, inflationary economic conditions, are we headed towards a recession? But you just said that is not your base case. So what is your base case for the US economy right now?
Look, we absolutely assume slower growth as a result of all that is happening around us. It's inevitable that this will have negative impact on US growth ahead. However, we believe that it is still likely that we settle around 1.5% growth in the US. There is some downside risk to that number, but from 1.5%, even with some downside, there's quite a long way to negative readings. And to us, the key question is really about the health of the US consumer, because so far, US consumer has proved itself to be resilient to the extent that very few investors expected. Two key factors really helped US consumers. First, the fact that the labor market's been pretty strong. We have not seen any meaningful pickup in layoffs within the US market, away from all the drama to do with Doge. We have not really seen any material negative shift in the labor market. And the other thing that helped is so many consumers refinanced mortgages when the rates were around 3%. So they're not feeling the pinch from higher level of interest rates. If we start seeing layoffs increasing in a material way, to us, that would be a reason to worry, and that would be a reason to start discussing recession as a more probable scenario. But for the time being, we're just reflecting on the fact that when we're looking at sentiment data, it's been quite wobbly. It's been quite weak in recent weeks. However, when you look at hard data, it has been pretty robust. So we're not seeing the evidence yet in US economy of the consumer weakening aggressively. And for as long as that is the case, we do not believe a recession will happen in the same way as recession did not happen in 2022 when so many investors were expecting that outcome.